Welcome back. Today we're looking at an investment strategy piece about finding high-quality oversold stocks, the author calls them compressed springs, that might rebound after the Fed's recent rate cut.
Yeah, interesting timing. And a key theme, like you said, is that difference between a falling knife and a compressed spring.
Right. And the criteria for the spring, strong balance sheet, clear moat, profitability, that's all laid out quite well. Seems like a solid base.
It is. The terminology is good too, punchy. That ampu
Uh,
savakini. Don't catch it. It definitely grabs your attention.
Uh-huh. But, to really make that warning hit home, the contrast needs to be, well, structural. I think to maximize the impact of the whole thesis, the distinction between the langevnuga, the knife, and the kokosuratud vidru, the spring, it needs defining more structurally. Okay, yeah, I see what you mean. The example used for the falling knife is AST Space Mobile, ASTS. It dropped, 23% after a huge speculative run-up?
Exactly. And the piece notes analysts think it's overvalued?
So that shows volatility, sure. But is that really a falling knife in the sense of fundamental danger? Or just, a speculative stock correcting?
That's the weakness right there. The current example feels more like air coming out of a balloon. A correction from euphoria, not a business that's fundamentally broken. And that lessens the impact. It doesn't give you that stark, logical contrast you need for the don't catch it warning. A real falling knife shows a structural failure, something that lower rates just can't fix.
Okay.
We need to drive home the point that this high-rate environment we just came out of, it really exposed deep flaws, not just froth.
So how do we sharpen that? What's the suggestion?
Well, the suggestion is to make the falling knife example the explicit opposite of the compressed spring's core features. If the spring has a rock-solid balance sheet and makes money.
Then the knife needs to be about what? A decaying balance sheet? Unmanageable debt?
Precisely. Balance sheet decay, debt can't handle. That sharpens the contrast dramatically.
Okay, that makes the whole argument much clearer. So, concrete examples. Instead of a volatile tech stock like ASTS, what kind of company profile fits that structurally broken idea better?
Think about a company maybe in an older industry with an obsolete product or just one that levered up way too much.
Right.
Where the higher interest payments over the last couple of years fundamentally crushed their ability to operate, maybe even triggered debt covenants or serious solvency risks. That kind of business is permanently impaired.
So even with rates coming down now, it's too late for them. The damage is done.
Exactly. The description needs to talk about, say, a failed business model or overwhelming debt, not just analysts think it's overvalued. We want to show the difference between quality getting temporarily hit by macro forces and junk getting permanently broken by them.
Got it. That distinction is crucial for the whole strategy to hold water. Okay, that strengthens the structural argument. But what about the emotional side? The piece mentions the estate context, the local Estonian uncertainty.
Yes, and that's a really powerful element.
The author rightly points out that local investors feel fragile, slow growth here, inflation still sticky.
Yeah, 1.5% growth, 3.8% inflation, it makes people nervous.
Right, so there's this psychological pressure to just wait, sit on cash, see if things improve locally. And the author says, no, if you wait, you miss the global train.
Which is correct. But we need to lean into that local feeling much more. Leveraging that local economic uncertainty, that fragility mentioned in Part 3, I think that will significantly boost the psychological punch and the counterintuitive feel of the strategy.
So what's the weakness currently? It is mentioned.
It's mentioned, yeah, but then it sort of gets dropped. The examples given, SAP, Akamai, Centene, they're all global, mostly US-focused plays.
True.
So there's this disconnect. You bring up this potent local pain point, this Estonian context, and then you leave it behind. That weakens the narrative tension. That local anxiety should be the reason why this global strategy is not just good, but maybe even necessary right now.
Ah, okay. I like that. Use the local discomfort as the setup, the foil, for the global trade. That feeling of wanting to hide money in a sock because things feel bad here, that's very real.
Exactly. So the suggestion is to reframe parts 3 and 5. Explicitly connect the dots. Link that feeling of local stagnation and inflation pain directly to the need to find these quality, global compressed springs.
So frame them as an antidote? A way to get growth outside the local sluggishness?
Precisely. These aren't just abstract good investments, they're potential defense against what's happening or not happening locally.
Okay, give me an example. How would you frame, say, SAP using that lens?
Well, when discussing SAP, the big, established German software firm, you frame it explicitly as a reliable structural growth engine that's totally insulated from Estonia's 1.5% growth woes. It offers growth despite the local cycle.
Okay, I see. And what about something like Centene? That's in the patient's check category. Sounds like it's facing some headwinds. How does the local angle play there?
That's where you connect the emotional difficulty. Centene's facing sector panic, right? Worries about medical costs.
Mm-hmm.
You link the hesitation an investor might feel buying into that panic directly to the general caution they already feel because of the local Estonian economy. You say something like, look, you feel hesitant about buying Centene because you're already feeling cautious about the economy here.
Right.
But that broader fear, which is getting reflected globally in this sector-specific panic, that's exactly what creates the opportunity in a quality name like this. It makes the psychological hurdle much more relatable.
Yeah, that's clever. It turns the reader's own immediate environment, their own anxiety, into the justification for the contrarian move. Okay, powerful reframing there. Let's move to the third point, the stock categories themselves. SAP, Akamai, Centene. Good names, solid reasoning.
Eat, but maybe a bit standard. Strong balance sheet, clear moat. It's good value investing 101.
Exactly. It feels a bit like buy quality on sale, which is always good advice, but maybe misses a trick related to the timing.
Right. So the discussion of why these specific compressed spring criteria matter now could be sharper. It needs more originality by explicitly linking the Fed's rate cut, that specific event on October 29th, to the idea of duration risk in these particular companies.
Okay, duration risk. So the weakness is that the link between the Fed's signal and why these specific companies benefit is a bit generic right now. Lower rates help growth stocks. It sort of loses the uniqueness of the Fed pivot moment in the analysis that follows.
Precisely. The suggestion is to focus the analysis on how that change in the discount rate, coming directly from the Fed's move, disproportionately revalues the long-duration cash flows you find in these kinds of forgotten or stable companies.
Ah, okay, so it's not just that they're good companies, it's that the math of valuation changes in their favor more significantly right now because of their cash flow profile.
Exactly. It adds a layer of mechanical justification beyond just value. We're not just buying quality. We're playing a specific valuation re-rating driven by the rate change.
That definitely adds originality. Let's walk through it. Category 1, SAP, boring is the new sexy. How does duration risk apply specifically there?
Well, for SAP, you emphasize that these big, mature software giants, they run on predictable, often long-term contracts. Lots of cash flow way out in the future.
Right, very stable.
So when the Fed cuts rates, the discount rate used to value those far-off future cash flows drops. Mathematically, this boosts the present value of those distant earnings much more significantly than it would for, say, a speculative tech company burning cash or a business with very short-term cycles.
Okay, so SAP's stability gives it long duration, and falling rates give that duration a bigger valuation uplift.
You got it. It's a direct mechanical effect of the rate cut on that specific type of cash flow profile.
And Akamai, Category 2, forgotten technology, it's infrastructure, the internet piping.
Similar idea, but maybe with the growth kicker. Akamai provides essential infrastructure, right? It's critical plumbing for everything online, including the whole AI boom, even if they don't make the fancy chips.
Foundational.
So it represents stable, long-term growth potential with a high moat. When rates fall, that kind of predictable infrastructure-like cash flow becomes really attractive, especially compared to pure speculation. Capital starts looking for that safety and duration. Lower rates make investors appreciate that long-term foundational value more. It pulls money back from maybe frothy AI names into the enabling infrastructure.
Got it. So it's about the quality and predictability of the long-term cash flows becoming more valuable as the discount rate falls. That really anchors the why now aspect to the Fed's move.
Exactly. It elevates the thesis beyond just finding good stocks that are down.
Okay. This feels like a really solid set of refinements. So just to quickly recap the main points for the listener. First, we talked about sharpening the core metaphor.
Yeah, making that falling knife a true structural failure, not just a correction. To really contrast it with the compressed spring's resilience. Maximum contrast.
Second, really leaning into the Eastie context, using that local economic anxiety not just as background, but as the key psychological driver for making these global contrarian bets.
Turning that local pain into the reason the global opportunity feels necessary and timely. It boosts engagement.
And third, adding that layer of originality by linking the stock criteria, the stable cash flows, the moats, directly to the mechanism of the rate cut, specifically through the lens of duration risk.
Right. Explaining why these specific long-duration assets get disproportionately revalued when the Fed pivots, moving beyond generic value arguments.
So the actionable steps seem clear. 1. Rework the falling knife example for structural contrast. 2. Weave that Estonian context throughout the psychological argument. 3. Explicitly connect the stock picks to duration risk and the rate cut's impact.
That's it. Refine the counterexample, integrate the local psychology, and elevate the why now using the rate mechanics. We think these changes could really make the piece resonate even more strongly.
Definitely. We really encourage you to take these points on board, revise the piece, and please do send the updated version back to us. We'd be very interested to see how it develops.
Absolutely. Looking forward to reading it.